तो अनुपम ऐसा कहते हैं ना कि सर नहीं झुकाएंगे सर कटा लेंगे, बट इक्विटी इन्वेस्टिंग में सर झुकाना अच्छा होता है, सर कटाना अच्छा नहीं होता है.
Looking at a checklist, you're saying one is sunrise sector, two is gaining market share,
Yeah.
three is earnings growth,
Yeah,
right? Anything else that that I can say, okay, tick mark here.
Like in two-wheelers, I think some of the companies have become 10x in last 10 years, and some of the companies have remained there. So within the sectors also, you will find there will be some set of companies which will do extremely well at the cost of others.
Folks, welcome to Paisa. I'm your host Anupam Gupta, and on today's episode, we are talking about PMS strategies with my guest Sheetal Malpani, CIO at Tamohara Investment Manager. Sheetal, welcome to Paisa. Thank you so much for doing this for our audience.
Thank you, Anupam, for having me.
It's great to have you here. Tell us firstly, what does Tamohara mean? How old is it, and when did you set it up?
So Tamohara is one of the name of Lord Shiva. तमस को हरने वाले, which means
chaos.
अंधकार को हर लेते हैं. So it is a path to enlightenment. And Tamohara was started way back. We'll be completing near about a decade in the month of October.
Sure.
Roughly today we are managing near about 450 odd crores in AUM across PMS and advisory. We have just started our FPI offering. We have become advisor to an FPI fund.
Oh, nice.
And the objective of when we started, mid-caps and small-cap companies were coming of age. The investable universe was increasing. The corporate governance was improving in small and mid-cap space. So they were not big enough to be part of mutual fund portfolios, but they were big enough to be part of any PMS strategy.
Okay.
And on the other hand, I think equity as an asset class was being accepted, especially the post-regime change in 2014. There was the equity cult which was in the offering. So we thought that on one hand, investors are ready for higher risk appetite product. And on the other hand, there are opportunities which may not be the part of mutual fund at this point of time because of sheer size and scale they offer, because of the liquidity constraints. And if we can marry both, we will have a differentiated product offering in a sense, which will be very differentiated for our clients as a whole. And I think our experience for the last 10 years is reasonably okay. And I think as far as the trend for equity investing goes, I think it has surpassed our expectations. The kind of cult India has seen in last 10 years as far as equity cult, especially post-COVID, is very overwhelming to say the least. So in that sense, I think the call to start a PMS has gone right at
very interesting. You said on both the sides there was demand. There was demand from the client side to invest money in a product like a PMS, and there was enough supply from the equity market side to give you companies that were worth investing in. Now that the second part, I'm assuming, can also be fulfilled by a mutual fund. Okay, just for our audience who probably has not invested or is considering investing into a PMS, can you just explain at a basic level how PMS and mutual funds are different?
So Anupam, PMS is a mass transit product. Take an example of a metro service. You want to go from point A to point B in a least cost effective manner, in a timely manner. You have to take a mass transit. People across all walks of life participate. Same as a mutual fund. If you want to participate in an equity market linked product, I think mutual fund provides you that opportunity in the least cost effective way. On the PMS side, it's like an Uber service. You want to go from point A to point B at your own convenience with your own defined strategy in a managed account form. I think you can do it. The only thing is that mutual fund has a tax advantage, as a tax arbitrage over PMSs in terms of buying and selling within the fund do not attract a tax incidence, where in PMS, every transaction will incur a short-term or long-term capital gain depending upon when you sell. But despite this tax disadvantage, PMS offers a unique proposition. In a sense, I have said that there are a lot of small cap, mid cap, micro cap companies where the liquidity is not enough for mutual funds to make enough delta in their NAVs. The liquidity is not there, free float is very small, the business model is evolving. As a PMS manager, because of the size, smaller size, nimbleness, we can participate in those opportunities. So in that sense, despite having a tax disadvantages over mutual funds, I think the kind of companies which are available as an investable universe or PMS, I think they are able to overcompensate in terms of the tax disadvantages which mutual fund have, which PMS have over mutual funds.
So the next logical question is, when your clients come to you, what have you seen in terms of how they typically use PMS in their asset allocation strategy? And I'm assuming that someone who has 50 lakhs to invest, because that I think is the minimum amount. No? It used to be 25 lakhs. Now it's 50 lakhs. I don't know, going forward, it might be more or less. I don't know that. But in your experience, when you speak to your clients and you see the way they do their asset allocation, how does PMS form a part of their overall, net worth or whatever?
So, Nupam, it differs from client to client. Typically, what we have seen, especially at Tamohara, my experience has been that a client whose portfolio becomes more than 2 CR, 2 crores and above, he starts to look at PMS as an asset class, as an equity asset class differently, in a sense. So it may vary from client to client. Some client who are very risk averse, they might want to reach a portfolio size of 5 CR to look at PMS. Some clients who are risk taking, they might look over 1 CR. But typically we have seen that client who comes to us, they have a mutual fund portfolio of 2 CR and above. And we have seen that a PMS client has a various PMSs. He will take one from us, one from someone else, and so he wants to experience 3-4 kind of PMS schemes. So it depends upon client to client, but incrementally, the one that net worth in equity side becomes about 5 to 10 CR. Incremental allocation to alternate routes to investing gets higher and higher allocation.
So do you think, now that you mentioned this, do you think that in terms of risk return, your client or anyone who has that kind of a portfolio size looks at a mutual fund differently and looks at a PMS differently?
I've seen that in mutual fund, the return expectation is pretty much realistic. They say that okay, it should be index linked or index plus 1 or 2%. Well, in PMS, they want returns at all point of times. They want best returns at all point of time. Once the market is down, they want an absolute returns. Once the market is in euphoric phase, they want alpha of 500, 600 bips. And they want quartile 1 performance at all points of time. So in that sense, the return expectations from PMS managers is pretty much high. And I think it has been marketed in that way also. So there's nothing wrong with the investor community to expect a high returns from per se. So mutual fund is a more or less beta product. And PMS is an alpha product, according to us.
Interesting. You just explained to our audience as to how the costing works, right? Because in a mutual fund, it's all in the NAV.
Yeah.
How does costing in a PMS work? As in, what do you, if you're going to give that kind of expectation at least, I don't know what actual or not, but अगर आप वो expectation रखने वाले हो कि this is the kind of product that you have, it gives you alpha, obviously the cost has to be higher. How does the costing work here?
Given the competitive nature of the industry, it's very difficult to have a very differentiated cost structure vis-a-vis your peer set. It may be mutual fund, it may be AIF in that sense. So in PMS, the cost structure can vary. You can have a zero fee, you can have a fixed fee, you can have a part fee, and a part performance fee. But mostly we have seen that I think a lot of people incrementally are preferring a performance fee structure where if you perform, we are ready to pay you. So it depends. Somebody has a hurdle rate of 8%, somebody has a hurdle rate of 12%, somebody has a profit share of 20%, somebody has a profit share of 15%.
So one minute, I'm going to stop you there. Hurdle rate and profit share. Just explain that one level lower.
On a basic sense, if you look at a lot of investors say कि why we want to pay you if you are giving us a 8% kind of return. वो 8% 7-8% तो FD में आ जाता है. So we want to pay you if you generate over and above an hurdle rate kind of return. So for 8, so typically supposedly every rate in India is right now 7% plus 1% and 1% premium मान लीजिए तो 8% की hurdle rate है. If a portfolio manager is generating a 20% return, 8% तक उसे कुछ नहीं मिलेगा. So on the incremental 12%, depending upon the agreement between the client and the portfolio manager, he will charge a fee. Typically हमने ये देखा 15 to 20% performance fee होती है over and above hurdle rate.
Very interesting.
So I think on an overall basis, I think the fees is as good as mutual fund on a 5-year rolling basis. Sometimes in a good market, PMS manager will be able to make out more money because of the performance. But on a 5-year basis, rolling basis, I think the fee structure should be 1.5 to 2%, which is similar in the case of mutual funds.
Yeah. You saying something about profit share also? Is that
similar? The profit share only. So supposedly you do a 0% hurdle and you whatever money you make, you charge it say 10% of the capital gain. Okay. So that is the sense.
And also, folks, just one small, very important difference is that in the PMS, as you know, if you've been watching the other episodes, the stocks are held in your name, in your demat account, and therefore what Sheetal just said about how the capital gains are levied on you, whereas in a mutual fund, obviously, they're levied at the fund level.
So PMS is very transparent product in a sense. Every transaction you make, if the investor wants to know, at the end of the day, he is able to get to know. So it's very transparent. And typically in reviews, what happens is that he will caution us or caution any of the portfolio managers on the stocks which have not performed. He won't look at overall portfolios in a sense. So it's very demanding demanding product per se for the portfolio managers to manage also.
Okay, so in your opinion, what will a true to label PMS do in terms of allocation?
There's a tagline of a paint company, or used to be a tagline. हर घर कुछ कहता है. ऐसे ही हर portfolio should be able to speak for his philosophy. without me being there, if I have narrated my philosophy on a pen and paper, when without me being there, if somebody can look at the portfolio and can make out that ये portfolio should be belong to such kind of fund managers or such kind of thought process. So that is true to label means. And true to label portfolio will have his periods of underperformance, because as we have seen, market will keep changing its style. Sometimes value will perform, sometimes growth will perform, sometimes private sector will perform, sometimes PSUs will perform in some sense. So true to label means that if I am saying I am buy and hold and my portfolio churn is 70%, it is not true to label. If I am saying I am growth investor, at the end of the day I buy a low price to book companies, that it is not true to label. Sometimes I am saying I'm a value investor and I buy 50-80 by P kind of stocks. So I think you have to be true to what you are saying, because see, as long as you are true to what you have been, what you are stating, investor will be able to hold up even if you are not performing, because we have already narrated that this is my style of functioning in some sense. And we have taken true to label one level extra in a sense that we do an active allocation.
Okay.
We don't do a model portfolio allocation because model portfolio is as good as NAV in some sense. You have a static portfolio and a client comes at point A, at some client comes at point B, the portfolio remains the same. And especially in this market, like market has become fast and furious. In 1 month, I think the whole, some of the stocks move by 50-60%. So what we do is that we try to do an active allocation. It doesn't mean that every client portfolio is different. What it means that a client who comes say, in the month of Jan and client who has come today, his stocks might be same. 80-90% stocks will be same, but I think percentage allocation to each of the scripts maybe a little bit different depending upon the residual incremental upside which we see in the portfolio in the next 3-year rolling basis.
Sure. Very interesting. So last question before we go into a break, Sheetal. Post-COVID era, everyone has been hooked to the markets. कुछ ना कुछ चलते रहता है, लोगों का ट्रेडिंग होता है, मतलब SEBI also had to come and interfere in that and pass some rules. People have started finding mutual funds also boring. I don't know about PMS, whether they've started to find PMS boring also. So, so how does one stick in the space and be true to label or build your assets where maybe your clients are just want to chase the flavor of the month or whatever?
Fads will come and go through, but historically we have seen that wealth creation with consistency has come through boring products. I think mutual fund as an asset class has shown resilience for the last 32 odd years. 93 mein, I think it became privatized where private mutual funds are allowed to. So 32 years ka ek track record, a solid track record hai. And similar case with the PMSs, they have a track record with them. So these fads of pre-IPO funds, unlisted equities will come and go through. Right now we are in a bullish market and everything looks rosy. But I think they will have their own period of drawdowns, and there will be times when people will say that these are very risky products. In that sense, I think mutual fund and PMS will again come to the fore. Sure. Boring to ho gaye hain because it is become, everyone has it at this point of time. Yeah. But I think the core of equity allocation will always be mutual funds, and satellite will always be PMS as per my understanding. And as the economic prosperity in the country is increasing, the newer set of investors who have never experienced PMS as a product are coming to the fore. It has become bored for some set of people, but I think the newer set of people are entering into the alternate routes for equity investing.
Very interesting. And folks, if you want to know more about Tamohara, check out the website. They've got a very interesting insight section, blog section, where Sheetal and I think Hiral, who's your head of
Harini, my co-partner.
Head of research.
She's a portfolio manager and my partner.
And partner. Both of them have got very interesting takes and deep level research on a lot of topics that they look at. So check out the website Tamohara, Tamohara. We're going to take a small break out here. On the other side, I'm sure you're wondering that how do you choose a good PMS? How do you differentiate between them? What is Sheetal's outlooks on the markets and sectors? All of that on the other side. Don't go anywhere. We will be right back.
Did you know Indians report nearly 800 cases of online financial fraud every day, which has resulted in losses exceeding 1,000 crores in the last 5 years? To keep you safe from such fraud, I am starting my newest podcast series, Conversation with Vigilante, an initiative by HDFC Bank. In every episode, I will feature special guests who can share expert insights on the different types of fraud, their modus operandi, and how you can protect your money. Stay safe, stay vigilant, and don't forget to tune into Conversation with Vigilante. Catch the episodes on all audio streaming platforms and V for Vigilante YouTube channel.
Welcome back. Sheetal, research and processes, right? Because that becomes very important in this era where thanks to the equity cult people think मैं तो अपना पैसा खुद संभाल सकता हूँ, मैं तो खुद रिसर्च कर सकता हूँ ना, मतलब why do I need a professional to do it? Today तो annual reports are there. But in terms of these two aspects, which are very, very important, research and processes, okay? We know that someone who's managing a mutual fund does it. They've come on our show, they've spoken about that. But from a PMS perspective, what do you bring to the table that's very, very unique and different from what, a DIY can do?
It's a temperament and discipline. तो अनुपम ऐसा कहते हैं ना कि सर नहीं झुकाएंगे, सर कटा लेंगे. बट इक्विटी इन्वेस्टिंग में सर झुकाना अच्छा होता है, सर कटाना अच्छा नहीं होता है. सो दैट मीन्स दैट यू हैव टू कट योर लूजर्स एंड राइड योर विनर्स. डीवाई इन्वेस्टिंग में क्या होता है? सो दे आर एक्सेप्शंस, द आउटलायर्स. जैसे तेंदुलकर आउटलायर है क्रिकेटिंग वर्ल्ड में, ऐसे डीआईवाई में भी आउटलायर्स हैं हु हैव मेड ट्रिमेंडस अमाउंट ऑफ वेल्थ बाय इन्वेस्टिंग ऑन देयर ओन. बट जनरली हमने देखा है कि इन 95% ऑफ टाइम people keep averaging in losers and they keep exiting their winners. और in real world opposite करना पड़ता है. And also DY investor gets emotional about their stock pickings. यार हमने लिया है, why, how can we go wrong? And we also go wrong, but I think we are unemotional about it. So I think it's just temperament and discipline, and especially in the world of disruption. On one hand we are saying AI is coming, this technology is coming. That means that the life cycle of each company is getting reduced. अगर पहले say maybe 20 years back, runway for growth for 20-30 years was there. Today the runway for growth may be for 10 years. So that means you have to be extremely nimble, you have to be extremely well read to know that how the disruption is impacting your company. On the other hand, we are paying high premium, especially in current markets. And if there is a disruption, I think your returns may get compromised, or you might end up making no returns or making losses. So in that sense, I think you have to be with professional money managers, especially at a scale, to manage your money. And temperament and discipline is utmost important.
So you have got temperament and discipline. That's great. I wanted to just go one level maybe deeper here. Like when before the recording started, we were talking about your trip in UP, for example.
Yeah.
I know for a fact that fund managers are on the road. Their analysts are on the road. Even in this day and age of AI, that thing of going down on the ground, visiting, traveling, especially in a country like India where, as is famously said, changes every 5 kilometers.
Yeah.
Right? Yeah. Talk to us about that. I mean, for our viewers to actually understand that how important it is to get up from that cabin, that Excel file, that annual report, and go out and meet maybe sometimes clients, sometimes companies, sometimes markets. Yeah. Let's talk about that.
So in our research process, we have a process that I think every analyst has to be on the road for at least 3 to 4 weeks a year. So typically we do a road trip once a quarter, maybe a week in 3 months once the result season is over. We pick any part of India and we try to travel near about 500-800 kilometers within that circuit. In that circuit, we'll try to meet small vendors, vegetable vendors, small businessmen, understand their viewpoints, how their business is shaping up. And we'll try to visit some of the stores of the company if they are present there. So if there is a retail company in which we have supposedly have an investment, or we like, or we want to investigate further, we'll stand in the front of the store for at least a year, for an hour or two. We'll see how many people are going, especially if it is a weekend, because it's a weekend business. So you'll get a sense, you will get a general pulse, because sitting in a AC room, we can have a view whatever we want to view. Excel will ultimately speak about a 15% growth, but actual growth is far different from an Excel growth. And going on the ground will give you a lot of perspective. It will open up your mind to your possibilities. Sometimes, usually, I think I've seen, 2-3 of our good pickings have come from the road trips, which it was not intentional. It just came in the conversation that this is happening in this company, and this company is gaining market share, or this company, some salespeople are not up to the mark, and so on and so forth. So you get a lot of ideas, you get a lot of softer feels which you won't get in sitting in your cabins or conferences. So it is very important, and it gives you a perspective about India as a country also. So it keeps you very, very level-headed. We are a country of 140 crore odd people, and I think each subset people is very, very different economically. So in that sense, it keeps you very humble, and you feel very good about the profession you are into.
I would love it if you could write about this on your blog and your website, and share some of the findings out there. It'll be great to just know more, because you don't get those insights sitting here, like you said, in an AC cabin. I just also realized that the one advantage that you probably have is that you can get a lot of insights from your clients.
Yeah.
I'm assuming because they would be small business people, big business people, family office. Do you use that also as for inputs?
If some of our clients are in pharma, they supply to pharma companies, so and so forth. So they give insights somehow. But I've seen that I think the people who are very close to the action, they always have a biased insights.
So you take it to a pinch of salt.
Yeah. If they are not getting orders, they will say, oh, something is wrong in this company. If they are getting orders, they will say something is good in this. So you have to take with pinch of salt. You have to understand from which point the client is speaking, or the guy you are speaking to, from which context he is speaking. So if he's gaining market share despite company is doing bad, he will say, oh, everything is good. And if he has lost some relationship because of the change in management or change in style, he will say something is not happening right, and so on and so forth. It gives you a different perspective, and I think we take each of the feedback and then try to think that it makes sense or not, and incorporate in our understanding.
Okay. Last couple of questions, just kind of winding down the episode. I'll get to the section about choosing between mutual funds and choosing between PMS in a bit. But let's top down first, and then we'll do a bottom up after you're done with that. So top down, I think what I want to know from you is your take on macro. We just had a very good GDP print coming out, I think last week. How is that coming along? Within the macro, anything that's looking interesting or challenging to you? Let's start from there.
We don't do primary research on macros per se. Our view on macro is on bottom-up basis, to whatever inferences we draw from road trips or from the companies we talk about. So in that sense, but I think we are coming out of a cyclical low. So we went into a cyclical low last year in the election year, where the government was focusing on other issues, and consumers were leveraged. So in that sense, we are coming out of cyclical low. Monsoon at this point of time looks reasonably okay. The kind of predictions which we have seen, I think Bombay and other parts of the country have seen reasonable amount of rainfalls. So monsoon is looking up.
Yeah.
Last year there was a regulatory tightening on NBFC, which is getting reversed. There was a tightening in liquidity conditions, which is getting reversed. There was a tightening in monetary conditions, which was getting reversed. So all the headwinds which were there in the last 18 months are now becoming tailwinds.
Okay.
At the margin, I think tax cut will improve some of the consumption issues or some of the leverage issue which urban households were facing. Rural households should do well as rainfalls, if it is okay. I think they should do reasonably okay. And on top of it, for the last 1 year, we have subpar returns on equities. So valuation relatively has become cheaper, not cheaper as people want it to be, but they have become cheaper. So I think we are coming out of a cyclical low. As far economic wise, the news should be good. Only issue is that global headwinds will be there. So the policies at US, how this tariff war plays out, we don't know. But I think India on economy basis should do far better than what it has done in the last 15-18 months.
You're talking about valuation, sir. 17% का correction आया, 26,000 का 21,000 Nifty हो गया, which is fine. एक महीने में it's back. It's almost like within some distance from a new all time. मौका ही क्या मिला लोगों को करने में? I mean, okay, technically there were 6 months from September last to April, but this bounce back, I mean, you think the market fundamentally has changed? These bounce backs are happening so sharply, you can miss them.
We are in T20 world. So in 2 hours, game changes. So in 2 months, I think the market outlook changes. Anupam, on valuation, I want to highlight a point. See, if we are trying to look at valuations which used to be pre-COVID and which are today, they are expensive. But to expect similar kind of valuations is very difficult. In 2015-16, 1 crore investors were there in equity markets. Now there are 5-8 crore investors. So demand for equities has become 5x of what it used to be. To expect similar level of valuations which used to be pre-COVID, it is very difficult to come by. They may come, 10 साल में एक बार आएगी, and it will come in a jiffy, it will go in a jiffy. You need to act in it. So having said that, our valuations are expensive than the historical averages, but there is a reason to be it. A, demand is far higher. Our growth rates on earnings, corporate earnings is far higher. The macro stability of India is far better. Inflation is far more under control. Our GSEC yield is pretty much reasonable. It is at historical lowest differential with US. So in that sense, if you look at overall picture, valuation is reasonable, not supremely cheap as we want it to be. Ideally, I want it to be cheap, but it is pretty much okay. And my sense is that I think a lot of people come and say that large cap is reasonable. Yes, they are reasonable on longer term basis, but my sense is that large money incrementally will be made in small and mid cap space. The opportunity, the newer companies which are getting listed, if you are able to pick right companies which can compound at high teens or in mid 20s, there will be companies which will do that, which will do. And I think your job as a portfolio manager is to identify 10-15 companies out of 500 companies which are there. So large money will be made in small and mid-cap space, according to me, still going forward. Despite being higher valuations, you might see a time correction for some time, but I think big runway for growth is there.
So let's go into that, because my original question, like I said, was going to be top down and bottom up. But bottom up, I'm just wondering, do you do bottom up in terms of sectors, in terms of stocks? What is the process? Like, I mean,
we don't do sector wise, we just do stock wise. Our job, my job is to know 15-20 stocks, which is better than most of the market should know. Ideally, I should have an edge in those 15-20 stocks which I identify for my portfolio. And our objective is that can we generate mid-teens returns post fee on a longer term basis. To generate mid-teens returns, we need to identify companies which are growing, where earnings can compound at 18-19%. So post fee, which can give a 16-17% kind of returns to our clients, assuming no P re-rating or de-rating kind of sense. So we tend to identify companies which are either gaining market share or which are in the sectors which offers a long runway for growth, or which are sunrise sector. But yes, we are very cautious of valuations. We don't like to pay 50-80 kind of P at because I think we have seen that such kind of valuations generally in next 10 years time frame you don't make good amount of return per se.
So I'm sure that because of compliance you can't name specifics out, which is fine. Okay, but I'm just looking at a checklist. You're saying one is sunrise sector, two is gaining market share, three is earnings growth, right? Anything else that that I can say, okay, tick mark here on this checklist?
I think we focus a lot on terminal value. So many of the sectors which have a good runway for growth, but we see that the terminal value may be an issue. So we don't want to participate in such kind of companies where we feel that business might get disrupted in 5 to 6 year time frame. We tend to buy boring businesses where no one is looking at, which can compound in high teens. Banking is a sector where I think the valuations are reasonably okay at this point of time. There are other small and mid-cap companies, not sector specific. Within the sector, like in two-wheelers, I think some of the companies have become 10x in last 10 years, and some of the companies have remained there. So within the sectors also, you will find there will be some set of companies which will do extremely well at the cost of others. So again, the thing is that you have to go on the ground, do deep research, product-wise, understand the company, meet management, meet middleman, meet the vendor, and assess where you want to take your portfolio.
I'm just trying to think, how many sectors are there other than banking, which is heavily regulated?
Yeah.
Okay, which can be immune from disruption, or at least you can say कि यार चलो 5-6 साल तक तो इसका disruption नहीं है. एक ज़माने में क्या था, पेंट हुआ करता था ऐसा. Paint would be like this. Now everybody is doing paints.
वो जिस सेक्टर की वैल्यूएशन बहुत हाई हो जाएगी उसमें डिसरप्शन आ जाएगा बिकॉज पीपल सी मनी चेज वैल्यूएशंस. सो पेंट यूज्ड टू गेट वेरी हाई वैल्यूएशन इन इंडिया एंड वी हैव सीन लॉट ऑफ competition come through. So कोई sector immune नहीं है. There is no sector which is immune to disruption. I think management quality do take into account, as I've said, that in last 10 years also some of the sectors have not created wealth, but within that sector some of the companies have created a lot of wealth. So if you are able to identify right promoters, right set of management people who can transform their business despite disruption, I think value will get created.
Very interesting. Okay, now the last part, which is basically what's your advice to our audience out there when they're choosing between mutual funds? I mean, who is mutual funds for? Who is PMS for? Who is AIF for? I'll talk about SIF after this, but mutual fund, PMS, AIF.
They are all pathways to platforms to create wealth through equity. You can choose your own. Mutual fund will always remain the core. No investor can ignore mutual funds as a equity product. On top of it, I think if you want to participate in a small and mid cap, I think PMS do offer a very good route. Only job is that if you can identify the right set of fund manager, you should understand his philosophy, because there will be periods when he will underperform. But I think if you are in sync with his views, with his philosophy, and you believe that this will eventually play out, I think you should keep patience with such kind of fund managers. Typically, time horizon should be between 5 to 7 years for a full economic cycle to play out. And AIF is for ultra HNI, and I think people who want to participate in unlisted equities or pre-IP funds, because a lot of value creation is happening there also. So I think that is very nuanced product, for discerning investors who have high risk appetite, and who already have a equity allocation in traditional asset classes of more than 5 CR.
Okay, sure. And now SIF. I mean, what is this new category that's coming? I think it's got a threshold of what, 10 lakhs?
Yeah, it has just been notified on 1st of April. This SIF has a limit of 10 lakhs.
It's special
So investment funds.
Special. Sorry, go on.
It has a limit of 10 lakhs, minimum limit of 10 lakhs. It can do long short and it can use derivatives to enhance returns or to protect returns per se. So I think we need to give 1 or 2 years. Right now, some of the mutual funds are setting up teams for SIFs, and how the experience will be, time will tell. My sense is that I think as we move forward, there will be newer kind of products, differentiated offerings for equity investors to participate. As I've said, I think we are like US market. A lot of regulated product innovation will come through, where I think investors, according to their own risk appetite, flavor, can participate.
Okay. And how should someone who's watching all this, who's absorbed everything, heard everything now, how should he choose a PMS? You said that you have to believe in the fund manager and the philosophy and give at least 5-7 years. Want to just expand on that a little bit?
As I've said, I think PMS is far more involving product for investor also, because he gets to know what is bought and sold. The interaction with the fund manager is quite high in terms of there are quarterly calls which happens. So when an investor chooses a PMS, first of all, he should be attuned to the philosophy of the fund. You should be able to figure out that, okay, this is a philosophy, I'm okay with it, so I'm going with it. You don't have to look at on daily basis, but yes, you have to review your portfolio on quarterly basis. And I think in a year's time, you will be able to make sense that whatever the fund manager speaks and whatever he has said in his philosophy matches or not. If it is matching and it is underperforming, it's okay, because he has said what he's do. Even he's outperforming and it is not matching, then you have to be circumspect, because this is a path you're not chosen. So in that sense, I think you have to review your portfolio at regular intervals, but you have to give time to the person whom you have entrusted your money with. Ultimately, I think your mindset, your philosophy has to be mirroring with the guy whom you have entrusted money.
That's very interesting. Folks, that is probably the most important point that you need to understand if you're choosing PMS as a route for your investments. Final question, Sheetal, for all our guests, what book are you reading or any content recommendation that you have for our listeners, audience?
I will give you 2 book recommendations.
Nice.
One is very topical. So we have recently seen tensions at India-Pakistan border. So one book I was reading was on Kupwara courts. It's a incident narrated by a Gorkha regiment army man. It gives you a real life action thriller in terms of how they are able to decode a cryptic message and foil the terror act which could have happened.
This is a real life incident.
It is a narration, probably I think very close to reality. That is my sense. And अनुभव क्या होता है, जो इंसिडेंट होते नहीं पता नहीं पड़ते.
Correct.
So I think it was very fascinating read, and it also gives view into moral dilemmas which army man faces against time. Whether they have to bypass something to make sure that this incident doesn't happen, and the love for the love army men have for our country is just amazing.
Crazy,
So I think.
Do you remember the name of the book or the author?
General Manik Jolly, Kupwara Courts.
Kupwara Courts. Okay.
The other book is also topical in a sense. It is a timeless reading according to me. Recently, as the GDP print came, we hit a $4 trillion mark. So as we say that next 2 decades or centuries is for India. So I was reading a book called Golden Road by Viren Darampal. It talks about that India was the economic power. And not only the economic power, we had a lot of soft power of culture, religion, astronomy, medical science, so on and so forth. We were Sone ki chidiya, and we are about to become again Sone ki chidiya. So I think we were already there. Our place belongs there. Some of the things which we have forgotten. So it gives anybody who is bullish on India or wants to know more about India, I think should read. And I think probably next 20-30 years, he might foresee what he will read in that book, which is about to play.
Anything that William Dalrymple writes is great. This is Golden Road, right?
Golden Road, yeah.
Folks, those are 2 fascinating book recommendations. With that is a wrap on this episode of Paisa Vaisa. My guest, Sheetal Malpani, CIO at Tamohara Investment Managers. Sheetal, thank you so much for doing this for our audience.
Thank you, Anupam, for having me.
Great to have you here.
Thank you.